Hey everyone, Rich Monroe here with B&B Investing Group. Thanks for jumping on this week. As you know, B&B Investing Group helps investors kind of navigate the different strategies with short-term rentals, whether you're doing acquisitions, leasing, or managing properties. And so a big part of what we are all doing, obviously, in our market is constantly kind of paying attention to occupancy levels, pricing, and what's going on in the market. And so have a good friend of mine here today with us from AirDNA. And Bram, thanks so much for taking the time to jump on and kind of give us an update on what's going on in the market. Why don't you tell us a little bit about yourself?
Sure. Well, thanks for having me, Rich. Yeah, so I have been examining hospitality in the Atlanta area for about the last almost 10 years. I was with CBRE in their big office downtown, or in Buckhead, I should say. Always feels like downtown to me because I'm all the way out here in Marietta. But I used to look at hotels for them and do forecasting for hotels, including Atlanta, the Atlanta market, for a number of years. Doing a lot of participation with events with Cobb Travel and Tourism. Lately, I've been working with AirDNA because my good pal, yours and mine, Jamie Lane, he went over to AirDNA because he loves to think about short-term rentals. He thinks it's a really exciting space in the hospitality market, and I had to agree. He invited me to come over to AirDNA about 2 years ago, and I said yes. So I've been studying short-term rentals, been very, very interested in the Atlanta story. It's one of the very interesting regulatory story, and that's sort of a big topic of conversation across the nation right now with a lot of different laws, whether it's sort of the Georgia state preemption law or the New York enforcement, or other sort of proposed laws around the nation. But, people are wondering about it. And I've always thought Amsterdam has been a really good resource and a really great model for organizing to make sure that regulations, deleterious regulations, don't pass.
Yeah, no, most definitely. And, most of our B&B Investing Group members are here in Atlanta or in Georgia, but we do have other members that are probably watching today from other parts of the country. So I do know that we are going to kind of focus on Atlanta. You and I are both based here, and a lot of our clients and members are based here in Atlanta as well. So it'd be interesting to kind of see how we're comparing to the other cities and how some of the other cities are comparing to us. So what's the overall kind of climate like currently with, just in general in terms of short-term rentals? I know a lot of us, during COVID and post-COVID experienced, the increase in occupancy and higher nightly rates. And then we kind of leveled out quite a bit after that. And a lot of different markets really kind of got hit pretty hard in terms of much lower occupancy levels. And so what's the current environment looking like from your perspective, Bram?
Yeah, great question. And to your point, yeah, I'm based in Atlanta, but I specialize in hospitality markets across the U.S. So, if you were to look at this first slide I've got here, forgive me, but as an economist, I do love graphs and charts and stuff like that. But yeah, you can sort of see the story here of the pandemic, the decline, I guess, in listings, and then the growth afterwards as we sort of tried to recover. That 2021 period was actually probably the highest performing period for short-term rentals that we've ever seen, and probably that I will ever see, barring another catastrophe like we saw with COVID. But what we've seen then is because of that incredible performance that happened in 21 across the nation in many, many markets, because short-term rentals were able to mobilize so much more quickly than hotels. A lot of attention was paid to this space. Some of it good, some of it bad. A lot of people got interested, and that was really phenomenal and something that was really great. A lot of people entered into this market, in particular because we had very, very low interest rates as well. So there was, it was easier to buy a second home or say a vacation home and start renting it out during that low interest rate period than ever was before. But because of all that supply that was coming in, we did see an erosion, a pretty steady erosion of unit level performance that happened from 21. Occupancies were declining pretty much every year. They've only just started turning around, I should say, nationally with the May data, in fact. We're finally, I think, on firmer footing to say that 2024 is going to be a turning point year. We're going to stop declining unit level performance nationally. We're going to start increasing it once again at a more, I would say, normal, say long-term, long-run average kind of rate. When I'm looking at the U.S., though, Rich, I also want to contrast it with Atlanta because the stories are quite different. And just to speak, like we were discussing before we went on, regulatory situation in Atlanta is still a little up in the air. Now, we've paused enforcement, which is great, but you've still got these laws in the books that are somewhat unfriendly to short-term rentals. And this does have a discouraging effect on new investment. The other thing about Atlanta, too, I'd like to point out is it's not so seasonal. Atlanta is a nice place to visit all year round. So we don't see those big seasonal, increases and dips as we do the rest of the nation. But yeah, we do see that supply kind of flatten out and level out, maybe even decline a little bit at the end there. And we're way, way below the pre-COVID trend. And we still haven't made it back to that, to some of the levels that we had seen pre-pandemic.
Yeah, I definitely think some of that decline, yes, I agree, is the uncertainty with the regulatory environment. But I gotta think that a lot of that could be attributed to the slowdown in occupancy over the last 12 months, 12 to 18 months as well. A lot of folks, I mean, myself included, we actually kind of pivoted a little bit with our business about a year ago and started focusing on some of the larger properties and less focus on some of the smaller properties because of the margins starting to get very thin with lower occupancy and lower nightly rates. So I would say that the leveling off there and kind of the little bit of the decline is kind of a combination of those two pieces, I would think.
Yeah, and don't forget too, when we're talking about people entering into this market, interest rates, of course, are an important part of that because your borrowing costs increase. That's money off of the bottom line, and also housing prices, and those shot up in Atlanta like crazy during the pandemic. They did like nationally, but in Atlanta in particular. And we haven't actually seen housing prices retreat very much at all, even with these higher interest rates. So that makes it very difficult, I think, to come up with, say, a new supply plan or a new short-term rental plan for a bunch of investment. And you can see that this is nationally the supply growth, and I can go through these slides pretty quickly. You can see it's down 6.5% nationally, so it's definitely come off. And this is that interest rate stuff I was talking about, as well as housing prices. But in Atlanta, it is particularly pronounced. So you can see there, 6.5 nationally, but negative 0.7 here, the supply growth in May of 2024. So supply is definitely more slowly growing in Atlanta. In fact, maybe even starting to retreat a bit.
So real quick question, Bram. When we're looking at these stats for Atlanta, is this the Atlanta metro area or is it Atlanta, the city limits of Atlanta?
Oh yeah, I should say no. This is the sort of metro area.
Okay.
It's the competitive set. So this includes Decatur, DeKalb. It's going to include Alpharetta, Roswell. It's going to have Buckhead in there. It's even going to have some stuff in my neck of the woods like Cumberland and Marietta as well. So that sort of big blob that we consider Atlanta, colloquially, idiomatically, but not the city limits only.
Gotcha. Perfect. Okay. And those of you guys jumping on, if you wouldn't mind, throw a quick yes in the comments. Just want to make sure you can hear everything okay and see everything okay, and give us a thumbs up. Appreciate it.
Yeah, and I always want, to your point about occupancy, the declines in occupancy that we've seen in Atlanta over the last few years. Now, this is not necessarily just confined to the Atlanta market. I also want to point out too that we are seeing supply slow down nationally. We're seeing it slow down a lot in Atlanta. But demand as well also is starting to accelerate nationally, especially. You can see here the blue bars are the demand, and they're generally higher on the right than they are on the left. There's been a little bit of up and down. Easter the Easter shift made April particularly weak and strengthened March a little bit because it made spring breaks a little bit earlier. But generally speaking, those blue lines are a little taller on the right than they are on the left on average. And here it is for Atlanta. It's a little bit tougher to see here, but I think with Atlanta and their occupancy story, it's not really necessarily a story of demand coming back and being really strong positive, but it's that supply that's consistently negative and lower as far as the supply nights is helping the occupancy. You've got less supply out there, you get a higher occupancy with the same amount of demand. And just to compare and contrast, what I mean when I say that is you can see here, this is nationally. Occupancies have also been going down, so it's not just an Atlanta thing. 2021 was that high water mark. Again, that July of 2021 is really high. I don't expect that we'll ever reach that level in the short-term rental market again. It's much more usual to see that dark blue line. That's our pre-COVID sort of trend. But every year it has been going down pretty fast in some instances from that orange line, and then we go to magenta for 2022, then again 2023 with that light blue line, and then finally in 2024 that black line, which is sometimes above, sometimes below the previous year, but year to date we're down nationally 1.5. If we were to look at Atlanta, on the other hand, we see a similar pattern. We didn't see as big of an occupancy boost in 2021 compared to pre-pandemic in Atlanta as we did with the rest of the nation. But on the other hand, we didn't see quite as big of a decline. So there is still a pretty marked decline. We're below pre-pandemic levels. But if we look at this on a year-over-year basis, because Atlanta's got the supply that's slowing more quickly than the rest of the nation, the year-to-date occupancy in Atlanta is actually up 2.5% rather than down 1.5% like the whole nation. So there are some unit performance benefits, I think, from this slowing supply. Even though demand is not super strong, we're still getting some nice occupancy from increases compared to 2023 because of that lower supply.
Can we go back just a few slides to the demand? I just have a quick question on the demand piece. So how are you guys defining demand, and how is that measured?
Right. So what we do is we collect all of the data from, say, Airbnb's website, as well as VRBO and a few other platforms as well, book.com and sort of related sites as well. And what we can do is actually we check every listing every day. So we've got their calendar in mind. And when we observe some of those calendar days, become unavailable, we had this sort of machine learning algorithm that was developed with MIT a few years back that takes 17 different sort of metrics into account. And it can decide whether or not that vanishing availability is due to, somebody blocking some days, the listing going unavailable, essentially, or if it's actually a demand night, someone actually staying there. So when I say demand nights, I mean one listing has been checked out for one night, regardless of the number of bedrooms. That's considered one demand night. Does that help?
And so, yeah, that does help. And so Atlanta, like for April, for example, very close to negative 15% in demand for the month of April. But now in May, we're kind of closer to a little bit higher than about 5%, or closer to 5% in demand.
Right. And some of that, I should point out, a lot of that, decrease in April was, again, because of that calendar shift and the spring breaks moving. That definitely made April much weaker than it would have been otherwise. And it did boost March a little bit. But, in particular, the boost was seen more in sort of coastal areas rather than in Atlanta, and even farther south, even warmer locations than Atlanta as well.
Got it. Okay. Sorry about the get it out of order. If you want to jump back into the occupancy, and guys, if you have any questions, feel free to throw them in the comment section, and we'll dedicate some time towards the end here to address any of your questions. But
Right.
Bram's got his
Well, yeah.
finger on the pulse of this data, so feel free to throw any questions out there that you might have. Go ahead,
And
Bram.
if you kind of squint through one eye, you can still sort of see the blue bars are lower on the left on average than they are on the right, certainly still. So I think that we are kind of reaching that turning point in the market, that demand is starting to stabilize. In economic conditions are certainly improved from a year ago. Wages are now outpacing inflation instead of the other way around, which really, really helps. There are a few possible snags that we could hit, but I imagine that this demand is going to continue to improve. And again, that constrained supply is helping out that unit level performance. So we'll keep paying attention as we approach sort of the off season as well to see what might happen there. But something that that Atlanta really has, and it speaks in its favor, is its rate story. And you can see this is nationally. Rate was very bad in 2023 nationally. It was negative for the entire year, essentially. Whereas in Atlanta, it was not the case. And there's two reasons for that. One, I think, is, in 2023, we did have that really slowing supply, and that helped two ways. One, it sort of bolstered our occupancy just a little bit. It was not quite as low as it might have been. And the other thing is mix shift. We saw essentially all the new supply that was added to the market this last year was kind of cut rate, low ADR stuff. And that tended to lower the average rates. Since we didn't see as much supply change or shift around in Atlanta, we didn't see that mix shift as strongly. So it's more stayed, it more or less in pace with inflation, sometimes above, sometimes below, and recently more above than below, which is very nice. I think it's an exciting development. So that's sort of rate. And
that really amplifies what we all enjoyed post-COVID in 2021, and how extreme that price increase was. All right.
Right. And I will point out too that, just like I said before, the lot of the sort of lower rate nationally, this sort of negative in 2023, this was because of all that sort of low price product that was coming in. If you opened a new short-term rental listing in 2023, it was probably going to be on the cheaper end, because you think about, people were thinking about their budgets back then. Inflation was high, wages were not keeping up with inflation. People were paying more for their groceries, a lot more for their rent. So if you wanted to attract new demand, you were probably going to try to open up a more economic location or listing. Whereas in 2021, what you would do is you wanted the biggest house possible, because that was what people really wanted. They wanted to be able to move their friend group or socially distance with their family in a large house that was removed from an urban area. So you saw ADRs there increase as a result of the mix shift. And there might be some of that too, that, some of this rate maintenance here might be because that what you were speaking to earlier, Rich, is, those margins are very, very slim on the 1-bedroom, 2-bedroom homes. Mm-hmm. So just as new listings nationally were on the cheaper end, it may be the case that, new listings such as they were in Atlanta over the last few years have been on the larger side, again, to sort of take advantage of those economies of scale that you can realize.
Mm-hmm.
But that I like that, and we can when we look at the submarkets, we can see that this ADR has really helped out some submarkets in particular. Just to give, this is the top 50 markets. Atlanta, of course, is a top 50 market. And I've got that by, number of listings. So here we can see, well, where is our demand growth? Again, we are not growing demand the most quickly. You see New York, of course, that's the really slowest, because they've just made short-term rentals practically illegal over there. Maui's got terrible wildfires. And then Lakeland, Winter Haven still recovering from some hurricane damage. But after that, pretty much all of these are your sort of natural growth rates, with the exception of Jersey City, Newark, all over way here on the left, picking up all those folks that can't go to New York now. So we're on the lower end, but that makes sense to me because you can't grow demand very, very quickly unless you're also growing your supply to accommodate that demand. And that's what we've seen in Jersey City and Newark, a lot of new supply to accommodate demand from New York. And Myrtle Beach has also grown very, very quickly. Even places that have had a lot of regulation in the past are still continuing to grow their supply. Boston's a big example of that as well. So considering the low amount of supply growth that we've had, this is still a pretty healthy demand change to me. And our ADR change is not the highest as, in addition to that. And I've got these two dots, or I got these two colors here, ADR, that's the average rate. And I talked about mix shift a little bit, are new listings going to be more expensive or less expensive, bigger or smaller than the existing listings? Well, that green dot right there, that's if we take new listings out. We only take the repeat rents, or the listings that have been in the market for a while. And if we look at those, what are those listings doing? And we see in Atlanta, actually, our repeat rent, so removing the effective mix, is very, very, very close to what our average ADR is doing, which is not the case for a lot of these markets, as you can see. So, for instance, New York, very, very high ADRs, but that's because they've just made all the cheap places illegal. Only the 30 days or longer, very big, elaborate places are still up for business. So their ADRs have shot up, but not because of people willing to pay more, but because of the mix shift. Atlanta, because our supply growth is a little bit smaller, it's much more in line with one another. I want to talk too about, we want to talk about the future as well. I do have just a few things, and then the slideshow will be over. I know we all see a lot of slides. I also wanted to announce I'll make this available via PDF, so no worries if you don't need to scribble down notes or anything like that. But I also wanted to look at pacing. Here's U.S. pacing. So we're actually looking at a pretty strong between 8 and 12% for the rest of the summer. So this kind of speaks to that idea that we're at that turning point. Economic conditions are improving. Mark Zandi from Moody's, he pointed this out to me the other day, and I thought it was a really good point, is that mortgage rates are really high right now. But Rich, do you own your home, or do you rent?
I own.
You own?
Personal
Did you
residence
in 2021?
Gosh, no. I'm at like 3%.
You're at yeah. All right, you're at 3%. Yeah. So you didn't need to. You're already there. So you've got that locked in at that low rate. A lot of people are the same way. We have really high mortgage rates, but nobody bought a house this last year, hardly. I've got realtors calling me up, asking for something to do because they're just sitting on their hands. So actually, a lot of people either bought at a very low rate or they refinanced when rates were very, very low. So in fact, the average interest rate that Americans are paying on their mortgages is, I think, the lowest it has been this century currently. So that really helps. Because even though mortgage rates are high, it's something that I hadn't thought about, but it makes a lot of sense when you put it that way. So if they're not paying all that mortgage interest, they've got a little bit of extra money in their pocket, might as well go on a vacation. The other nice thing too is that home prices have stayed high. Usually they go down pretty sharply when interest rates go up because of that mortgage payment stuff. But because we didn't really trade any homes in the last 12 months or so, housing prices haven't really shot down. They've maintained value, and that's very important because that means people still feel wealthy as well because they own this home and it's keeping its value. It's not going underwater or anything like that, which stresses people out to no end. So both of those things combined, I think, are really going to help consumption and vacations this next year. That, and of course, low unemployment rates, which persist. We also have one of these for Atlanta, for the Atlanta host. I know you're eager to see, well, this is great for the nation, but what are we doing? But I want to point out something, and I'm in the forecasting business, and this is my least favorite thing about Atlanta, and probably the audiences as well. The lead time is just incredibly short, just very short. One of the shortest of any markets that we have. And here I've got sort of the lead times for all the demand that we've got, because again, we know when that reservation is made because we're checking every listing every day. So we can tell how many days before that reservation date people make the reservation. And it was around 20 to 25, maybe even 30 days before the pandemic. When the pandemic happened, it shot down as it did everywhere.
Yeah.
But in Atlanta, it never got back up to where it was.
Never recovered.
Yeah.
Where everybody's still making last minute decisions and waiting a week or so or less than that to book.
It's incredibly frustrating. It really makes it really hard to predict what's going to happen. And it looks like actually in this dotted line here, this is a 12-month trailing average. So imagine shifting it to the left 6 months, and then you'll have more of a centered average. But I believe that there's a little bit of noise here, but I believe lead times have actually been shortening over the last year. Hopefully they're going to go up in this summer. We'll see. That lead times is one of the things we don't have really good forward looking data on, because you sort of have to see what the final demand is before you can average up the lead times. My suspicion that they'll be increasing as we go into the summer, but over 2023, I believe that they did decline. They went down, and that makes it really hard to predict. So if we look at our summer pacing, we have good numbers for July and August, 6% in July, and then 13% for August. If you recall, August of last year was too hot to go anywhere.
Yeah.
So there was it's kind of an easy comp. But afterwards, September, October, November, December, it doesn't look so good. But with lead times as short as they are, what does this on the books demand even actually mean for most of us? Not much. But I am expecting summer to continue with this pattern of strength that we've seen so far in the year, which is to say not super strong, but it's better than 2023. We're getting there. I think it's going to improve continuously, but it's very difficult to predict now what's going to be happening in the off season. And then the last slide that I have, and I'm going to leave this one up here, I guess, because there's a lot to unpack. I took all the submarkets in Atlanta, in the Atlanta market, that have more than 300 or have 300 or more listings. And I arranged them by how much RevPAR has changed over the last 12 months, essentially, and broke that down by, well, what amount can we attribute to ADR versus occupancy? And then ADR is in orange and green is the occupancy. And it's very interesting. Occupancy makes up a little bit. We change the occupancy just a little bit for a lot of these places. And in some instances, say Summer Hill, it was enough to actually drive RevPAR down. But when we look at some of the places that have been, very successful, West Midtown Atlanta, downtown Atlanta, South DeKalb, Buckhead, Marietta, where I'm at, if you look at those places, it's almost entirely due to ADR growth that we've been able to grow RevPAR.
Yeah, this is super helpful, guys, for those of you that are looking in the Atlanta metro market and trying to make decisions on your properties and looking at future plans. Bram, for the folks that are fairly new, and for some of us that don't really follow the jargon, give us a breakdown, please, on RevPAR. How do you define RevPAR?
Oh, yeah, I'm sorry. Great question. So RevPAR, that's the money statistic. Everybody always cares the most about RevPAR when they finally figure out what it is. It's the revenue per available rental. And essentially you take all of the days that you have available in your market, whether or not people stay there or not. And you take all the revenue that you made in the market, no matter, how many days that you rented, you take all of that revenue and you say, well, how much revenue do we have per day that we made available? So we're just dividing one by the other. Essentially the total revenue divided by the supply. So the interesting thing about that is because occupancy is just demand over supply, and ADR is revenue over demand. If you multiply the two together, the ADR and the occupancy, then that's what gives you RevPAR essentially. So it takes into account both the rate and the occupancy in the market, and it gives you sort of this number that you want to maximize. You want to get as high as possible.
And to give you just a little bit of a different example, so if your average nightly rate is $100 and you only have the property booked for 3 nights, so you have a $300 total, but you have it available for 30 nights or the full month of 30 days. So then your RevPAR is your $300 divided by 30, or $10. So just to kind of break it down as an example. So the RevPAR in that example would be $10, which is obviously very low, but that's how you calculate RevPAR. And that's typically what the hotel industry uses to determine performance on hotel rooms. And so it's basically the same thing for short-term rentals. So just wanted to point that out to folks.
That's exactly it. And, for people who are wondering, like, well, what is revenue management? I've heard a lot about revenue management. Revenue management is a very simple concept. It's just, you set the price. That's it. But there's a lot of nuance, because, if you increase price, then you're probably going to start discouraging occupancy. And because you're trying to maximize the product of the two, one's going to be going up, the other one will go down, or vice versa. You want to have a careful balance between the two to try to get the highest RevPAR that you can.
But if I drop from Mars and I'm trying to figure out where I want to go spend some investment money, where do I want to buy a property, where do I want to do my next master lease strategy, this chart right here is invaluable, because it's basically letting you know where the recent change in nightly rate and occupancy have been an impact compared to some of the other markets. And so it allows you to kind of get a clearer understanding of what that opportunity looks like.
Right. And, this would be even more helpful if I had given it to you 12 months ago. And I do apologize for that, Rich. I wish I had thought of that at the time. But, so it's very important. And that's another thing. This data is really useful. But what I don't have that all of your viewers will have is the context of their particular market as well. So in this particular case, I'm more of the Martian. Everybody else has actually got some on the ground experience. So, prices increased last year in downtown Atlanta by a substantial amount, but occupancy went down. Does that mean that people are at a breaking point? I'm not sure, right? So if you raise the ADR a little bit more, are they going to just stop coming to downtown completely? I don't know. And conversely, in Dunwoody, you see occupancy has actually increased a little bit, even as ADR has gone down a little bit. Hey, maybe there's some room here for some big ADR improvement. And ADR is a great way to increase your RevPAR because it goes right to the bottom line, and occupancy has that little stumbling block that you got to clean up the place, after the guys leave. So if we could choose between the two, we like ADR. So maybe Dunwoody is an interesting place because of that sort of flip. It's got the orange on the bottom and the green on the top. But again, there's going to be a lot of, or East Point, which is even more pronounced. But yeah, it's going to take a little bit of shoe leather and a little bit of investigatory work on the part of anyone who wants to invest. But these fundamentals are a useful starting point, as you say.
Most definitely. So we did have a couple of questions. Let's see. I think we did address a few of the questions. We had a question about in which markets are we seeing the most demand? And we looked at that on not only on the across the United States level on that one chart, but we also looked at it within the Atlanta metro, separate markets within Atlanta. And so I think that answered and gave us a clear answer there on where we're seeing the most demand and kind of what that looks like. The other question we had is there more demand for properties with lesser or more bedrooms?
This is a great question as well. Right after the pandemic, as I was talking about earlier, there was a strong preference for more bedrooms. And in fact, the rule of thumb was the more bedrooms, the more money that you could make. And some people even got like really, really big houses. We eventually ran into some, diminishing returns, as economists would say. once you get a 20-bedroom place, that's more of an apartment building than a house. But 3, 4, 5-bedroom homes, that's still where we're seeing the greatest interest, the greatest supply growth nationwide, and we're still seeing occupancies increase and ADRs increase for those types of properties. So I would say that you've got a lot of places, urban areas especially. So if you're in downtown Atlanta, you're that's like an urban, large city urban area. You've got a lot of hotel rooms, and those guys are trying to compete really hard with the 1 and 2 bedrooms. They're going to try to put laws in place to try to keep short-term rentals from competing with them, as we saw in New York City. So there's a little bit of a price war. There's a little bit of extra competition with those smaller rooms, especially in big city urban, because hotels are still trying. They are not as recovered as short-term rentals. We recovered all of the demand that we had, years ago from pre-pandemic. Hotels are still trying to find that business traveler. They're still trying to get more conferences. So they're trying really, really hard to get business for the 1 and 2 bedroom sets. So 3, 4, 5 bedrooms, I think, are still the most profitable to invest in for short-term rentals, and it's because they have that separate use and are really distinguished from hotel rooms. They're not a commodity. Each one of those places is a unique place. It has a unique location. You can use it for things that hotel rooms just aren't very good at, like bringing those larger families or even groups of young folks I've heard travel together. And also in places too, you can see all of these submarkets. There are hotel rooms in some of these, certainly in Marietta, certainly downtown Atlanta or Buckhead, but not in, there's not a whole lot in Kennesaw, for example. So and there's a lot of youth sports there in Kennesaw that, it's really well suited for short-term rentals. So that's still, I think, where I would put my money for the foreseeable future anyway.
Yeah, and I think if you look at it statistically, market by market, city by city, there's a consistent trend of a lower number of larger properties, especially 4 and 5 and above bedroom count properties. So just naturally in each market, if you've got a large group, 10 or more people traveling together, they have less and less options to look at, right? And so I think that creates a definite, as one of those listings, it will create an increase in your occupancy levels as a natural result of that. Bram and I were just recently in Austin, Texas for a short-term rental conference this week. And Austin is one of those interesting towns, it's very similar to Vegas and New Orleans, for example, in Miami, where there's kind of a high bachelor party type town. And so we actually toured a 4-bedroom property that could sleep up to 14 people. And they have large groups of folks that come in and they keep steadily booked. They take advantage of some of the larger bedrooms, and they put queen size bunk beds, in some cases 2 in each room. And so now all of a sudden in 1 bedroom, you can sleep comfortably up to 8 people. And so that's another reason why, to Bram's point, it's very difficult for hotels to compete with that, because, it's a whole different experience for sure.
Yeah, I would definitely. And, the other thing that I heard a lot in Austin was, you don't want to have just a run-of-the-mill average commodified product as well. And, again, hotels are super good at that, right? You can have Hilton Garden Inn is going to look the same anywhere you go. So you're very well assured of that. But what short-term rentals can do, and I think that the larger bedroom count really helps with this, what they can do is really make themselves stand out, really have a unique look, unique feel, unique location, lots of different, ways to stand out.
Yeah, and the other thing I'll add to that is it's not only large families and younger folks that are traveling in groups like that. You've also got business travelers. We get quite a lot of bookings for companies that recognize the economic benefit of putting 5 employees in a 5-bedroom house for $350 a night compared to 5 different hotel rooms. And whether it's a corporate traveler or a kind of a contractor that's traveling and spending time in the city to do projects, we're seeing quite a bit of that. And I think that adds to the filling out that demand for the larger properties as well.
That's interesting that you bring that up, because I know since COVID, remote work has been this huge trend, and hotels have struggled to get that business traveler back because of the technologies that we've got that we're using right now, Rich. But I think that if you had that short-term rental and you started advertising that way, or maybe trying to appeal to that, there could be that value proposition that you could give these businesses. You say, well, you're still spending on travel, but it is so much less, and you can get so many more people there to have all that face time that it's worth it again to have business travel. So yeah, that's a really good point.
Cool. So before we shut down for the day, Bram, what's your outlook on the market? I know you did some forecasting there for us, but what is your gut telling you what the rest of our summer is going to look like and going into the end of the year?
Well, I don't see supply turning around real quickly, and there's a good variety of reasons for that. The Federal Reserve, no matter what it does this year, there's going to be a delay in transmission of whatever kind of interest rates they cut to the housing market. So interest rates are going to stay high. They've already said they're going to keep them higher for longer. That's been the phrase that they've used over and over again to describe how they're going to keep inflation down. Is they're going to have higher for longer, and that's what we're expecting. So I'm not seeing supply able to bounce back really quickly. In fact, I'm expecting supply nationally to continue to decline at least until the end of 2025. That supply growth. We'll probably see, we can see similar pattern in Atlanta if there is some more of this regulatory uncertainty stuff that is dealt with. There might be a bit of renewed interest in investment for some folks. But again, it's still going to be, there's a lot of headwind for property investment over the next few years. So that's going to be tough. But on the positive side, we've got, that's a good question about election years. I don't have stats on that. I had to say in Austin too, they asked me this. I don't believe it's going to have a huge effect on Atlanta short-term rentals. Who knows what'll happen in DC? I'm glad, that I'm not speaking to the DC alliance right now, because, that could be chaotic. But who knows, maybe opportunity filled. But I think overall, we're still going to see continued strength in the demand because of some of those economic things. Incomes are going to be going up. Oxford Economics predicts that real personal income is going to increase. It increased in 24. It's going to increase more quickly in 25 as well. So, that really bodes well for consumption. People's the share of money they're paying out of their paychecks for debt is lower now because of those low interest rates that they locked in, and because that they haven't been buying houses with these new interest rates. So the balance sheets are still looking pretty good. Saving rates, they might go back up a little bit. People had a lot of free money after some of the stimulus packages. That, of course, is long gone. On the other hand, if I were to look at service spending and durable goods spending, this is something that we touched on in Austin, but it wasn't. I don't know if it was explained fully, but consumption on goods went way up in the pandemic because you're not going to be spending on services. You don't want to get your nails done. You certainly don't want to travel to some far off city and stay in a hotel where you could get COVID. So we saw services decline. That has not yet recovered its relative share of spending. On the other hand, that means that it is growing more quickly now than goods spending. Because naturally, there is a preference that people have for services versus goods. And we've been buying too many goods for too long right now. So we're starting to amp up our services spending to try to make up for that. And, there's a lot of talk, too, about as baby boomers retire, they like to have experiences as well. Younger generations, very experiential in their preferences. So I'm pretty confident over the next, couple of years, we're going to see demand continue to power forward. So demand going up, supply going down, occupancies are going to go through the roof, ADRs will follow, and we're all going to be making vast fortunes. Well, maybe not.
I hope you're right in your prediction. That's for sure.
I'm maybe not vast, but I am positive about profitability of short-term rentals over the next few years for those reasons.
All right. Well, very cool. I will have you back in about a year, and we'll see how your predictions made out. How about that?
Yeah, sounds great. We can do it. We can do it before a year's up as well. If you want to do, another quarterly update, that would be fine as well. We're expecting the first interest rate cut in September. That's what Oxford Economics is thinking. So if we were to do it in 3 months, we would know if that was actually the case or if inflation stayed too high for the Fed to actually decrease interest rates.
Well, let's definitely plan on that. I'll have you back next quarter, and we'll see how it's looking from there. And Bram, thank you very much for taking the time today. If anyone would like a copy of Bram's presentation from today, just shoot me a quick Facebook Messenger message, and I'll make sure that you get a copy. Bram, definitely I'll have you back again. We're getting a lot of thanks in the comments from the folks that are watching, so we really appreciate it. Thanks everybody for checking us out this week. B&B Investing Group, we help short-term rental investors navigate and scale a business. So if you feel like you're ready to start growing and adding more units and you want some help with that, feel free to reach out to me directly as well on Facebook Messenger, and we can check in with you and see if this will be a good fit for you or not. So Bram, thanks again, buddy. Really appreciate it.
Thanks for having me. It was a lot of fun.
Yeah, and I'll see you in a couple of months.
Sounds great. Yeah, sorry to write myself back, but you know what? I just had
that's perfect. Would love to have you back. Thanks, everybody. Take care. We'll see you next week.
Bye.